Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me back on.
So, if you've looked at your retirement portfolio or, opened a brokerage app recently, you probably have a severe case of emotional whiplash.
Oh, absolutely.
Right. It feels like driving down the highway at 80 miles an hour while someone just keeps yanking the emergency brake.
Yeah, that's exactly what it feels like.
One day the market is just soaring and you feel like an absolute financial genius. And then literally the very next day, it plummets. You're convinced the entire economy is just collapsing.
It is an incredibly disorienting environment right now. For any everyday investor trying to make sense of this, especially folks who are just starting to take control of their own financial future, it's tough.
It really is.
The volatility we're seeing is just, well, it's enough to make you nauseous. It completely defies standard market logic.
Exactly. And,
Yeah.
that brings us to the core mission of today's deep dive. Because according to recent market analysis, specifically focusing on the really wild swings we saw in late June of 2026, the biggest threat to your money right now isn't actually an AI bubble bursting.
Right. It's not the tech stocks.
No, and it isn't the Federal Reserve either, and it isn't picking the wrong stock. The absolute biggest risk to your wealth is, the squishy mass of gray matter sitting inside your own skull.
Your own brain.
Your own brain. So today, we're going to explore how to survive extreme market volatility by, managing your own psychological biases.
Which is so crucial.
It is. We're going to use the absolutely wild bipolar roller coaster of the AI stock market as our prime example to understand why our brains betray us and how we can build a system to actually fight back.
Yeah, and to really grasp the psychology here, we need to set the scene a bit. We have to look at the exact trigger for this behavioral
Just
trap.
lay it out for us.
So we need to put the days between June 23rd and June 25th, 2026 under a microscope. Over the course of just 48 hours, the global stock market exhibited what I can only describe as clinical mood swings.
It was crazy.
Yeah, on Tuesday, the narrative was pure panic. Everyone was saying the AI bubble was finally popping.
Right. Doom and gloom everywhere.
Exactly. But then, by Wednesday afternoon, the narrative had violently flipped back. Suddenly, AI was an unstoppable juggernaut that was going to save the world again.
Okay, so let's unpack this timeline. Because for a beginner investor, this looks like pure chaos.
Yeah.
What exactly happened on June 23rd that triggered that massive wave of panic?
Well, based on the data we have, June 23rd was a bloodbath for global tech stocks. The epicenter of the panic was actually in Asia, specifically South Korea's KOSPI index, which dropped nearly 10% in a single day.
Wait, hold on. KOSPI, that's South Korea's market, right?
Yes, exactly.
So for a U.S.-based investor listening to this, why should they care about the South Korean stock market taking a hit?
That's a great question. You have to understand that South Korea is essentially the factory floor of the global AI boom.
Oh, okay.
Yeah, so American companies design the brilliant AI chips, right? But Asian semiconductor companies are the ones who physically manufacture the memory components required to make them work.
So they're building the actual hardware.
Exactly. And because of that crucial role, the KOSPI index had practically doubled in early 2026. It's basically the canary in the coal mine for the entire U.S. tech sector.
Wow. So when that canary drops dead.
Right. When the KOSPI suddenly collapsed by 10%, U.S. markets immediately panicked.
A 10% drop for an entire national index is massive. That's not just a bad day for a single company. That's front-page news type of dropping.
It's huge.
So what was driving that massive sell-off?
The analysis points to a perfect storm of three things. First, there was this growing fear that AI valuations had just gotten completely disconnected from reality.
The classic bubble fear.
Exactly. Second, there was a sudden macroeconomic panic about the Federal Reserve potentially hiking interest rates, which we will dive into a bit later.
Right, the macro stuff.
And third, you had a real structural issue. Highly leveraged retail investors.
Okay, meaning everyday people borrowing money to buy stocks.
Exactly. People were borrowing money on margin to buy tech stocks. So when prices started to dip, their brokers issued margin calls. They were forced to sell off their stocks at any price just to cover their debts.
Which just feeds the crash.
Precisely. It accelerated everything. The overarching narrative that day was terrifyingly clear. Everyone thought the AI party is over.
So everyone literally runs for the exits. But then, like you mentioned earlier, the market completely reversed course the very next day.
It did. It completely flipped.
How does a narrative that strong just vanish overnight?
It vanished because reality stepped in with hard data. On June 24th, semiconductor giant Micron released its quarterly earnings.
And I'm guessing they were good.
They didn't just beat expectations, they absolutely crushed them. More importantly, they revealed $22 billion in customer commitments.
22 billion with a B.
With a B. They proved that the demand for high bandwidth memory, the specialized hardware needed to run these massive AI models, wasn't just hype.
Right, it was real money.
Exactly. It was backed by $22 billion of cold, hard cash commitments from corporate customers.
Wow.
And recent analysis shows that this incredibly optimistic outlook from Micron, followed closely by strong data from Qualcomm, instantly added over $400 billion to the market cap of semiconductor stocks.
That is just wild.
It yanked Asian markets out of their free fall and sent U.S. tech stocks skyrocketing right back up.
For an everyday investor watching this, it feels entirely random. It's like driving a car where the GPS screams at you to make a hard left to avoid a cliff.
Right.
And then literally 3 seconds later, yells at you to make a hard right because it made a mistake.
Yeah, that's a perfect analogy.
So is the market actually this indecisive? Or is there something else going on under the hood that we just aren't seeing?
Well, the thing is, the market isn't indecisive. It is just a highly complex, hyper-efficient machine processing millions of data points every single second.
Okay, so it's not a person with mood swings.
Right. It doesn't have a single personality. It is constantly pricing in both good news and bad news simultaneously.
So the volatility isn't the problem.
No, the real danger here isn't the volatility itself. The market is supposed to fluctuate based on new info. The danger is how our human brains try to process that volatility.
Ah, right. Back to the squishy gray matter.
Exactly. When faced with a massive contradictory flood of information, our brains just get overwhelmed. So to protect our ego and save mental energy, our brains look for shortcuts to simplify the narrative.
And that shortcut is what gets us into trouble. We are talking about confirmation bias, right?
Spot on. Confirmation bias.
Because the market is throwing all these conflicting signals at us, we just cherry pick the ones that make us feel good about the choices we already made.
Exactly. Confirmation bias is the trap. In a market with extreme two-way interpretations, investors will only see the news that validates the investments they already own.
So they ignore everything else.
Yeah. Recent behavioral analysis shows exactly how this plays out. Let's say you are an investor who is highly skeptical of AI.
Okay. A bear.
Right. You think it's a giant fad, you sold your tech stocks, and you are sitting on a massive pile of cash. When June 23rd happens and the Korean market drops 10% amid fears of retail leverage and Fed rate hikes.
You're doing a victory lap.
Exactly. You look at your screen and think, I am a genius. I was right. The crash is finally here. You feel completely validated.
And you probably completely ignore what happens the next day, right? Yeah. But what about the person on the other side of the trade? Like the person who put their entire life savings into AI stocks?
The AI bull does the exact opposite. They conveniently ignore the terrifying 10% drop and the margin calls on June 23rd.
They just pretend it didn't happen.
Yeah, they dismiss it as just a temporary glitch. But when Micron releases that massive $22 billion revenue commitment on June 24th, they point at the screen and shout, "Look at the numbers, I was right."
Just a buy the dip opportunity.
Exactly. This is a buy the dip opportunity and the bears are idiots.
Okay, wait, let me push back on this a little bit.
Sure.
Isn't it generally a good thing to stick to your convictions? We are always taught that long-term investing requires patience and a really strong thesis.
True.
It sounds like you're saying that being a loyal fan of your own portfolio is somehow a bad thing.
Well,
it's like we're sports fans watching a football game, right? When the referee makes a bad call against our team, we scream at the TV and call it a rigged game.
Right, of course.
But when our team gets away with a penalty, we just shrug and take the yardage. That's just human nature.
Yeah.
Doesn't having that kind of loyalty in investing keep you from, panic selling?
I see why you'd think that. I really do. But sports and investing have one critical, unforgiving difference.
Which is?
In sports, being blindly loyal to a losing team just costs you some pride. And the game ends, you go to sleep, and your life doesn't really change.
Fair enough.
But in the stock market, being blindly loyal to a losing thesis costs you your life savings. Reality doesn't care who you root for.
Oh, wow. That's a harsh way to put it, but yeah.
The danger doesn't come from the market being complicated. It comes from the investor artificially simplifying the market just to defend their own ego.
Right, ignoring the referee's good calls.
Exactly. Ignoring the opposing team's good plays, or in this case, ignoring the valid data that contradicts your portfolio, it will eventually bankrupt you.
Because both things are true.
Yes. In late June 2026, the bad news about interest rates and the good news about AI memory demand were both completely real, and they were happening simultaneously.
So if confirmation bias is the disease here, it sounds like rationalization is the main symptom. Like we just start making excuses for why the data we don't like doesn't matter.
That's exactly what happens.
So let's break down how this actually destroys wealth. Starting with the people who try to play it safe. How does this trap the conservative investor?
The conservative trap is insidious, honestly, because it disguises itself as intellectual rigor. Being overly cautious can be just as destructive as being reckless.
Really? How so?
It comes down to a psychological concept called loss aversion. Humans actually feel the pain of losing money about twice as intensely as the joy of making money.
Oh, that makes sense. Losing $100 hurts way more than finding $100 feels good.
Exactly. So let's look at our bearish, cash-heavy investor again. They see Micron announce $22 billion in solid customer commitments.
Which is undeniable proof.
Right. It is an incredibly strong, undeniable piece of data indicating the AI industry is healthy. But the bearish investor immediately rationalizes it away.
What do they say?
They say, sure, the revenue's there now, but the profit margins are too high to last. Or eventually the companies buying these chips won't see a return on investment and the whole thing will just collapse.
Okay, to be fair though, that sounds like a totally reasonable concern.
Yeah.
I mean, companies can't just spend billions on data centers forever if they aren't making money from the end user.
Right.
Why is that rationalization a trap?
It's a trap because, while it could be a valid concern for the future, it is being used right now as an excuse to completely ignore new factual data.
Ah, I see.
Loss aversion forces you to stubbornly refuse to update your views when reality changes. Think about it. If a company hands you a spreadsheet proving they have $22 billion in locked-in orders,
And your only response is to invent a hypothetical future scenario where it doesn't matter.
exactly, you aren't doing financial analysis at that point. You are just defending your ego because you don't want to admit you were wrong to sell.
That makes total sense. Pessimism often sounds a lot smarter than optimism, so it's easy to hide behind it.
Very true.
Okay, so that's the conservative side. On the flip side, we have the aggressive investors, the ones who think AI is going straight to the moon and nothing can stop it. Yeah. What is their specific trap?
The aggressive trap is completely ignoring macroeconomic gravity, and specifically, the gravity of interest rates.
Okay, explain that a bit more.
Let's look at the broader economic context of mid-2026. We have the Trump administration in the White House, and the market is constantly digesting new policies.
Right, like tariffs and trade renegotiations.
Exactly. Tariffs, trade deals, big fiscal spending pushes. Now, while these policies can definitely stimulate certain domestic industries, they also carry inflationary pressure.
So prices go up.
Right. And data shows that in early June, most economists thought the Federal Reserve was going to freeze interest rates, or maybe even cut them.
But inflation stayed high.
Yes. As inflation data remains stubborn, partly due to these macro policies, the futures markets actually started pricing in a rate hike.
Oh, wow.
And for the aggressive tech investor, higher interest rates are pure poison. It doesn't matter how good the AI technology is.
Okay, here is where it gets really interesting, but we need to break this down for the beginner listener. Why are interest rates poison to a tech company that is making billions of dollars? Like, if an AI company is wildly profitable, why should they care what the Federal Reserve does with interest rates?
To understand this, we need to explain a concept called a multiple.
Okay, what's a multiple?
When you buy a stock, you aren't just buying the company's profits today. You are paying for a claim on all the cash that company is going to generate 10 or 20 years into the future.
Right, you're buying their future.
Exactly. A multiple is basically the height premium you are willing to pay today for that future growth.
Okay, I'm following.
So when interest rates are close to zero, money is virtually free. Investors are super happy to pay a massive premium for future tech profits.
Because they can't get good returns anywhere else.
Exactly. But when interest rates rise, the yield on super safe assets like U.S. government bonds goes up.
Oh, so I can just buy a safe bond instead.
Precisely. Suddenly, investors don't have to take massive risks on volatile AI stocks just to get a decent return. Because the safe alternatives become more attractive, the mathematical present value of the tech company's future cash goes down.
So the premium shrinks.
Yes. Even if the AI company has fantastic earnings, the multiple that investors are willing to pay for the stock just shrinks.
Okay, I think I've got an analogy for this. Tell me if this works.
Let's hear it.
So for the optimistic investor, confusing a great company with a cheap stock is exactly like buying a beautiful, perfect dream house, but you bought it with a terrible mortgage rate.
Oh, I like that.
Right. The house itself is flawless. The roof is great. The neighborhood is amazing. The foundation is solid. That's the equivalent of a company having great earnings.
Yep.
But if your mortgage rate suddenly spikes to 12%, the math on the price tag doesn't make sense anymore. The house is still great, but the financial mechanics of owning it will basically bankrupt you.
That is a brilliant way to look at it, yes. And if you take that mortgage analogy one step further, ignoring the Fed's interest rate policy is like ignoring your bank's variable interest rate on your loan because you are too busy admiring your new kitchen cabinets.
Right. You're focused on the wrong thing.
Exactly. Good earnings prove an industry is fundamentally strong, but they do not justify infinite stock prices. If you ignore the macro environment, the math will eventually crush you.
Man. So what does this all mean for us? We know that our brains are actively working against us. We know that confirmation bias makes us ignore reality, and that both the overly safe and the overly aggressive approaches lead to absolute disaster.
They do.
How do we actually survive this? We need a system that forces us to look at the whole picture, even the parts that make us super uncomfortable.
We do, and relying on sheer willpower just isn't enough. You need a structural tool.
Like what?
According to behavioral finance experts, the ultimate survival tool is forcing yourself to physically write down the "what if I'm wrong" scenario.
Literally write it out.
Yes. If you are bearish, you must physically write down and acknowledge the strong AI memory demand from Micron and the rapid rebounds in the Asian markets. You have to look at the data that actively hurts your thesis.
And if you're bullish,
If you are bullish, you must force yourself to look at the rising Fed rate expectations, the high valuation multiples, and the massive risk of retail margin debt. You have to actively hunt for the evidence that proves you wrong.
it's basically institutionalizing humility.
That's a great way to put it.
But in practical terms, how do we know what data to actually look at? I mean, if the market is throwing 1,000 headlines at us every single day, how do we filter the actual facts from the panic?
You have to ruthlessly separate the signal from the noise.
Okay, signal versus noise. What's noise?
Noise is a daily stock jumping 3%, a pundit yelling on financial television, or, a viral social media post claiming the bubble has popped. That is all designed to hijack your emotions.
Right, it's just clickbait for investors. So what is the signal?
According to the data, the true signals you should be watching really boil down to 3 core metrics.
Okay, give them to us.
First, AI corporate spending, which is known as CapEx. Second, the Federal Reserve's interest rate path. And third, supply chain orders in the semiconductor industry.
Let's focus on that first one, CapEx. Why is corporate spending the ultimate truth teller?
So CapEx stands for capital expenditure. It's the actual cash a company spends on physical assets like data centers and servers.
Oh, real stuff, not just software.
Exactly. The reason CapEx is a signal is because talk is cheap. A tech CEO can use the word AI 50 times on an earnings call to artificially pump up their stock price.
Right, they all do that now.
Yeah, and that is pure noise. But when that same CEO signs a non-refundable multi-billion-dollar contract to purchase physical hardware from a company like Micron, that is a verifiable signal.
Because they're actually putting their money where their mouth is.
Exactly. You can fake a press release, but you cannot fake a $10 billion wire transfer.
That is so true. So if we monitor those signals, what is the actual strategy here? Do we try to predict where the KOSPI index or the tech sector is going to be next month?
No, absolutely not. Predicting the future is just another trap.
Okay.
Instead of having a view where you guess what will happen, you need to build a checklist that dictates how you will react to data when it arrives.
Okay, so walk me through this checklist.
Sure. In the short term, you watch the supply chain orders and the Fed futures markets. If a stock drops, but the actual hardware orders are still rising, you don't panic.
Got it. What about midterm?
In the midterm, say 6 to 18 months out, you have to look past the shiny AI label. Demand that the companies you invest in actually show real revenue growth, stable profit margins, and actual free cash flow, not just hype.
Show me the money.
Exactly.
Yeah.
And in the long term, you constantly rebalance your portfolio. When your AI stocks have surged and become a massive percentage of your wealth, you trim them back.
Take some profits off the table.
Right. You sell a little when things are irrationally high, and you buy a little when things are irrationally low. It keeps your risk balanced.
So basically, instead of trying to be a psychic with a crystal ball who predicts the future, I need to act like an airline pilot with a pre-flight checklist.
That's it. Exactly.
I shouldn't care if the wind is blowing slightly left or right from minute to minute, as long as I look down at my dashboard and my instruments, my CapEx data, my interest rate signals, tell me that the engine is actually running properly.
Precisely. A good investor is not someone who lacks convictions. A good investor is someone who has the discipline to decide in advance exactly what specific evidence will make them change their mind.
That is powerful.
If your checklist conditions are met, you act. You remove the emotion from the equation entirely.
Wow, this has been incredibly eye-opening. Let's quickly summarize for everyone listening.
Sounds good.
The wild market swings of late June 2026 showed us a fundamental truth. The stock market has incredibly powerful AI growth and incredibly serious economic headwinds happening at the exact same time.
Both are true.
Right. The reality is just messy. Your survival strategy isn't picking one side, getting a team jersey, and ignoring the other side.
Definitely not.
Your strategy is recognizing your own confirmation bias, ruthlessly separating daily noise from the core data like CapEx, and using a predetermined checklist to keep your emotions in check.
Because we cannot control the macroeconomic environment, right? And we cannot control the daily volatility, but we absolutely can control our process for responding to it.
I love that. I want to leave you with a final thought to ponder as you look at your own portfolios this week. We spend so much time endlessly searching for the ultimate financial indicator. A magic chart, an insider tip, or a perfect earnings report that tells us exactly when to buy or sell.
We all look for the easy answer.
But what if the most important indicator isn't a line on a chart? What if the ultimate predictor of your investing success isn't your ability to analyze the semiconductor supply chain, but simply your willingness to admit to yourself that you might be wrong?
Yeah, this is the real secret.
The investor who can look at hard data and change their mind is the one who survives the roller coaster. Thank you for joining us on this deep dive. Don't forget to subscribe and hit that like button.